Try to imagine this. Suppose I am a gigantic bank, a true giant of Wall Street. After extremely thorough research, I come to a very clear conclusion. Bitcoin is the future. Bitcoin is digital gold. Precisely, digital gold. And once you believe that, then the next logic is very simple. I need to own a very large amount of Bitcoin. But the problem begins right here. A real problem, a very painful problem. How do you buy billions of dollars worth of Bitcoin without pushing the price up against yourself? That is the key question. At this point, the story is no longer about believing or not believing in Bitcoin. It is a story about strategy. Because when you are a whale, you cannot act like a small fish. Every move you make creates big waves. And therefore today, we are not talking about how high Bitcoin will go. Instead, we are going to dissect a much more sophisticated question. How do these giants avoid destroying their own opportunities? Sounds interesting, doesn't it? Based on an analysis of financial strategy and market structure, we will dive deep into the tactics that these massive institutions use. And I must emphasize, right from the start, this is not the way retail investors buy and sell. Absolutely not. This is a game at an entirely different level. All right, let's start with the most fundamental difference. An individual investor can buy based on emotion, feel like it, and press the button. But banks cannot do that. If they step straight onto a public exchange and place a buy order, for example, $1 billion worth of Bitcoin, then it is exactly like a whale jumping into a small swimming pool. What is the result? It will wipe out the order book and send the price straight through the roof. That phenomenon is called slippage. And the price they have to pay for that carelessness would be extremely expensive. This is precisely the paradox of large scale. And to solve this paradox, they are forced to step into another world, a world in the shadows. The first tool and the most important one is dark pools, also known as dark liquidity pools. What are dark pools? These are private exchanges reserved only for large institutions where the entire order book is kept confidential. Unlike public exchanges where we can see every buy order and sell order, inside a dark pool, a massive buy order can be completely invisible to the outside world until everything has already been executed. And in reality, today they go even further than that. In the crypto market, many dark pools use extremely advanced cryptographic technology. It sounds a bit heavy, but there are two standout concepts you need to remember: SMPC and ZKP. Just hearing the names already sounds like a spy movie. Right, but let me explain it in the simplest way possible. Imagine a bank has a secret painting, and that painting is their massive buy order. Instead of giving the entire painting to a single person, they cut it into 100 pieces and give them to 100 different people. None of those 100 people can see the whole picture. But when they work together, they can still accurately confirm that yes, this is a valid painting. That is SMPC. It allows a large buy order to be broken into smaller parts and executed in a coordinated way without anyone knowing the full original intent. And ZKP, also known as zero knowledge proofs, is even more interesting. It works like this. I tell you that I know the password to a secret room, and I can prove that this is true without having to say the password out loud. In financial transactions, ZKP allows banks to prove that they have enough money to buy without revealing exactly how much money they actually have on hand. All of this ultimately serves only one single purpose: absolute concealment. But suppose this. Suppose a bank wants to buy such a large amount of Bitcoin that even inside a dark pool, it could still create ripples. Then what is there another way? The answer is yes. That is when negotiated trades, also known as OTC block trades, come into play. What does OTC mean? Banks work directly with specialized OTC trading desks, such as Coinbase Prime, Kraken OTC, or Cumberland. These intermediaries do not push orders onto the public market. Instead, they quietly source Bitcoin liquidity from many different places. And they do not buy all at once. They buy gradually following pre-programmed strategies, such as TWAP or VWAP. The objective does not change. Avoid sharp price movements, leave no trace, and do not let the market know who is really standing behind it. In essence, all of these strategies revolve around one very simple thing: buying in small increments, hour by hour, day by day, stretched over many consecutive months. It is like a submarine moving slowly beneath the surface of the water, creating no waves, leaving no trace. Bitcoin is absorbed gradually to the point that no one realizes a massive buyer is quietly accumulating. Therefore, the first step is always buy in silence. But that is not all. There is a strategy that is far more ruthless than that. Instead of merely trying to buy without being seen, they look for ways to buy precisely when others are forced to sell. Put bluntly, if you want to buy cheap, you have to find someone who is bleeding. And in any market, the weakest party is not the one who makes the wrong decision. The weakest party is the one who has run out of time. They no longer have time to wait. They have financial obligations that must be paid. They must sell whether they want to or not. And the place where the most forced sellers are concentrated is bankruptcies. The crypto market is not short of such examples: FTX, Celsius, Genesis, Voyager. Each collapse leaves behind a treasure trove. Tens, even hundreds of thousands of Bitcoin are frozen, waiting to be liquidated to repay debts. And this is exactly the stage for a strategy called stalking horse, also known as the lead bidder. So how does this strategy work? Imagine you participate in an auction for a house that is being foreclosed by a bank. You arrive very early and say directly to the bank, "I will definitely pay $5 billion for this house." Not lower. At that point, you become the floor price. The bank is reassured that the asset will not be sold at a fire sale price. And to reward you for opening the bidding, they give you a few incentives. For example, if in the end someone else bids $7 billion, you still receive a thank you fee. And more importantly, you're allowed to review the asset's documents more thoroughly than other buyers. In the crypto world, banks do exactly the same thing with tens of thousands of Bitcoin from bankrupt companies. And very often they are able to buy at a significant discount. That is exploiting an already existing collapse. But the next question is truly sensitive. Could they deliberately create a small crash in order to profit from it? The answer is yes. And that strategy is called predatory short selling. Predatory short selling is one of the most sophisticated tactics in this entire game. Banks do not act recklessly. They target entities they know for certain are using excessive leverage. For example, an investment fund that is borrowing money to hold Bitcoin. Once the target is identified, they unleash extremely aggressive short sell orders. This could be shorting the stock of that very entity, or directly shorting the price of Bitcoin. And most importantly, they choose moments when the market has thin liquidity. Hearing this, you might think, wait, shorting an asset as volatile as Bitcoin is no different from playing with fire. What if the market does not drop, but suddenly surges upward? That is a very reasonable question, and it is precisely where this strategy shows it is not blind at all. They have already calculated everything. They have analyzed their opponent's liquidation levels very carefully. Their objective is not to make money from the short position itself. The real objective is to trigger a precise chain reaction. A strong short sell pushes the price down. The price hits stop-loss orders. Then it continues to hit the forced liquidation thresholds of weaker players. A cascading effect occurs. And at that point, these entities are forced to dump Bitcoin at dirt-cheap prices to cover their losses. And this is the most critical moment. The instant the cascade begins, the banks close their short positions. Then they flip the trade and switch to buying. They absorb the entire supply of cheap Bitcoin that has just been created by that very panic. In other words, they do not just predict the storm, they are the ones who create it. And then they sell raincoats and lifeboats to those trapped inside. It sounds hard to believe, but in the world of high finance, the line between strategy and predation can sometimes be frighteningly thin. For them, this is simply exploiting market structure, a completely legal tactic. Hearing this, it feels like we are watching a Wall Street movie. With just one difference, the setting is now the crypto world. This market has matured and become far more complex than most people realize. But there is still another approach. Instead of buying Bitcoin directly, they can control the asset indirectly. And the company MicroStrategy, or now Strategy, is a more than perfect example. Strategy has created an extremely unique model. They issue debt to buy Bitcoin. And the question immediately arises, who is buying those bonds worth billions of dollars? The answer is large banks. In other words, banks lend money to Strategy. And what is noteworthy is that these loans often carry interest rates that are nearly zero. So where does the bank's benefit lie? In fact, this is a perfect double advantage. First is the right to participate in the upside. If the price of Bitcoin rises sharply, Strategy's stock also rises. At that point, the bank can convert the debt into equity and fully capture the upside. What is important? They can do this without having to directly hold Bitcoin, without having to worry about custody, at least in the initial stage. But the second advantage is what makes this strategy truly frightening. That is protection on the downside. If the price of Bitcoin collapses, the bank is still a senior creditor. In the worst-case scenario, they have the right to reclaim their principal. And even, they can seize the very Bitcoin that Strategy used as collateral. What does that mean? It means the bank wins in both directions. And from here, the story goes even further. Because they do not just buy Bitcoin. They can also make others pay them so that they buy Bitcoin through what are called structured financial products. This is the strategy of harvesting volatility. Take a very concrete example. J.P. Morgan's auto-callable, accelerated barrier notes linked to BlackRock's IBIT fund. The bank sells this product to investors who want to profit from Bitcoin, but are very risk-averse. What does the product promise? Leveraged returns, for example, 1.5 times, and a protective barrier, for example, 30%. If the price of Bitcoin does not fall more than 30% within a certain period of time, the investor's principal is preserved. It sounds quite attractive. So where is the bank's trick? It lies in how they hedge their own risk. When a bank sells a product that promises to protect the client's principal, if the price does not fall more than 30%, the bank itself must execute sell orders in the market as the price approaches that threshold to protect itself. And this is the most subtle part. These hedging sell orders do not merely react to the market. They act back on the market, and thus an extremely sophisticated feedback loop is created. Wait, what does this mean? It means that the bank's own risk hedging actions actually contribute to pushing prices down. And yes, that creates opportunities for them to buy in cheaper themselves. Hearing this, it almost sounds unbelievable. But the mechanism behind it is very cold-blooded. When the price of Bitcoin approaches critical barrier levels, the bank's market-making desk is forced to sell Bitcoin aggressively to hedge the products they have already sold. These sell orders create real selling pressure. And that pressure pushes the price even lower. In many cases, it is strong enough to sweep straight through the barrier, triggering losses for investors holding products that seemed protected. And this is the part that really sends chills down the spine. While the market-making desk is selling to hedge, the proprietary trading desk of that very same bank can stand on the other side ready to buy the cheap Bitcoin created by their own hedging activity. In other words, the entire system is designed to create an advantage. So the question is, could all of this really be within the legal framework? Yes. And what is noteworthy is that the rules of the game have just been completely changed. To understand that, we need to look at the legal playing field. For many years, the biggest shackle on U.S. banks was an SEC accounting rule called SAB 121. SAB 121 was like a pair of handcuffs. It forced banks to recognize digital assets they custodied for clients as liabilities on their own balance sheets. This inflated capital requirements, in an extremely unreasonable way. And what was the result? Custodying Bitcoin became extremely expensive for traditional banks, but then those handcuffs were removed. In early 2025, SAB 121 was officially replaced by SAB 122. A silent revolution. SAB 122 allows banks to record digital assets held in custody for clients off balance sheet, similar to how they treat stocks or bonds. What does this mean? Capital barriers have nearly vanished. The door has been flung wide open for banks, not only for large-scale custody services, but also for proprietary trading for Bitcoin-backed lending, and for an entire new financial ecosystem built around it. So what about international regulations like Basel III? Bitcoin is still considered a high-risk asset, right? Correct? Bitcoin's risk weight is 1,250%. Extremely high. But here's the thing. Banks do not only have balance sheets, they also have an entire arsenal of derivatives to maneuver around those constraints. So the question is, how do they do it? The answer is, they do not necessarily have to own Bitcoin directly. A very common way is through total return swaps. With this instrument, banks can capture the full returns of Bitcoin without holding it in their own name. The risk is pushed onto the counterparty, or even more sophisticated, they securitize Bitcoin positions, packaging them into complex financial products, thereby sharply reducing capital requirements. In other words, from a legal and accounting perspective, the playing field is ready. The only remaining question is timing. So, what signals are they stalking in order to deploy capital? There are two extremely important signals that they always monitor closely. The first signal is miner capitulation. After each halving, mining costs increase. Inefficient miners cannot hold on for long and are forced to dump their Bitcoin reserves in order to survive. It is like a failed harvest, where farmers are forced to sell unripe crops before harvest season. Banks closely track indicators such as hash rate. When the hash rate drops sharply, it is a signal that miners are capitulating. And that is the golden moment, to buy large quantities at cheap prices. The second signal is even more cold-blooded. It is the pressure of being removed from major equity indices. For example, MSCI has proposed a new rule expected to take effect in 2026. Under this rule, companies like Strategy, where more than 50% of assets are crypto, could be excluded from indices. And if that happens, it would trigger a wave of forced selling. Why forced? Because trillions of dollars sit in passive ETF funds. These funds do not think, they simply replicate indices. If Strategy stock is removed from an index, those funds are required to sell regardless of price. Billions of dollars worth of shares could be dumped onto the market. And you can guess who will be standing on the other side. The banks themselves, because they understand one thing very clearly: the value of the Bitcoin held by Strategy does not change just because the stock is removed from an index. This is not economic risk. This is an opportunity created by the mechanical structure of the market. And they will never miss it. When you connect all of these elements together, a full picture emerges. This is not simple buying. This is a precisely calculated encirclement. And this leads to a very important conclusion. It is not that they are smarter, but that they are playing a different game. They are not buying Bitcoin. They are restructuring the financial system to systematically, patiently, and ruthlessly pull Bitcoin toward themselves. This is a shift of power. These institutions are gradually transforming themselves from traditional monetary managers into gatekeepers of an entirely new asset class. So when looking at the market, perhaps the more important question is not where the price will go, but rather who will run out of time first, who is under pressure, who is in debt, and who has enough capital and patience to wait. Understanding that is the real advantage in this game.